we were given some of the variables. Of course, what you need to understand is the formula. Once we have the formula up here, we are able to apply the formula and get the unknown, which is the standard price. When I get to this other item here, I need to get the standard quantity in actual production, which I will be dividing by the actual production or actual units for me to be able to get the cost per unit that was produced. And that's what was getting us to, or taking us to, the actual production of SGM is 1080 units, and it happened that our standard quantity in actual production was equivalent to 1080. This one here led us to getting this particular cost, that is 1 unit of SGM was giving us 1 kg of this direct material. After getting 1 kg of the direct material to be the total quantity needed to produce 1 unit of SGM, we multiplied by the standard price per unit of that direct material, and that's what you are having there as. That's what we're having there as 10,000. That's what we are having there as 10,000. Okay, so I want us to go ahead using the same concept to go and look at what we have for direct labor. For direct labor, what are we going to get? What are we going to get there? Because it is from that direct labor which we will be able to get the prime cost part of this particular standard cost setup. Let me just read that still. By doing labor, I think we'll be able to catch up from where we stopped. Okay, so let's go ahead and look at direct labor. And of course, for direct labor, we are going to start with direct labor rate variance. So direct labor rate variance is equivalent to, remember we are dealing with the rate here. We are dealing with the rate. So what are we supposed to do? We compare the rates, the standard rate minus actual rate. Then all of that you multiply by actual labor hours that were used in the, or was given under actual results. So if you look at what we have there, have we been given the direct labor rate variance? Within this, we need to have only one unknown. So which item is unknown here? Are we given direct labor rate variance? If yes, what is the figure? Are we given standard rate? Are we given actual rate? Are we given actual hours? You will find that out of these 5 or 4 things, you will only have one unknown, and therefore you need to work backwards for you to be able to get that unknown, now that we have been given the variances. So let's go straight away to the question and look at the direct labor rate variance. What is the direct labor rate variance? What is the direct labor rate variance? Direct labor rate variance ni ngapi? Direct labor rate variance. Watu wananyamaza huko sana. What do we have? What is the direct labor rate variance? Direct labor rate variance. Tumepewa direct labor rate variance ni ngapi? Direct labor rate variance ni ngapi? Direct labor rate variance ni ngapi? Direct labor rate variance. Tumepewa ngapi? Tumepewa ngapi? The direct labor rate variance tumepewa ngapi? We have been given 40,000. So is it a positive, I mean adverse or favorable? Is it adverse or favorable? It is adverse. Is it? So we have 1440, and you can see the thousands that are there. Adverse, which means it's negative, equivalent to standard rate. Are we having standard rate in the question? Have we been given the standard rate? No, I think that's what we are looking for. Minus actual rate. Are we able to get the actual rate? The actual labor cost per hour. Is it given in the question under actual results? Additional information number 4. Was it number 4? Additional information. What was the actual labor cost? Direct labor, we are given 5760 hours and the amount is 41,760,000. So if you have 41,760,000 is the total labor cost. This labor cost was incurred when total hours is 5760 hours. So what is the labor cost per hour? Rate per hour. What is the labor rate per hour? What is the labor rate per hour? What is the labor rate per hour? What are we here? 72.50. So when you divide this one, you are getting 72.50. So I'll come here and take 72.50. To that, I divide by actual hours, which I'm able to see is 57.60. If that is done, I need now to break my bracket by taking negative 1440 is equivalent to 57.60 SR minus this times this. I think we are going to arrive at the same figure, 41,760,000. 41,760,000. How do I get SR? Standard rate. Standard rate is equivalent to bring this the other side. So we have 41,760,000 minus 1440,000. The whole of that we divide by 5760. If that is done, what is the standard rate? What will be the standard rate? What will be the standard rate? Standard rate itakuwa ngapi? What will be our standard rate? What will be our standard rate? What will be our standard rate? Somebody to help us there very fast. Itakuwa na 7,000. 7,000. Alafu tapata mtu anaandika 7,000 hours. Yet we are dealing with the rate. Okay, having done that, we go to direct labor. We go to direct labor expenditure. Direct labor expenditure variance. Direct labor expenditure variance. Okay, so if you look at that question, we've dealt with the direct labor rate variance. We now look at the direct labor efficiency variance. Direct labor efficiency variance. Are there some group of people here who are just coming to the office to wait for the departure time to reach so that they can get back home, or everyone is engaged in the production within the company? So how do we get the direct labor efficiency variance? We are basically looking at how efficient the company is utilizing the labor, how efficient the company is utilizing the labor resource. So it means the direct labor efficiency variance will be equivalent to, now we are looking at how they are going to utilize the standard hours less actual hours. Then to that we multiply by the standard rate. Standard rate, we've calculated it up there. Now, are we given the direct labor efficiency variance? Are we given direct labor efficiency variance? Are we given direct labor efficiency variance there? If yes, what is the variance? What is the variance? 25-20 adverse or favorable? Adverse. So 25 And of course, you should not forget, it is standard hours, nataka tuweke hiyo vizuri. Standard hours in actual production. Standard hours in actual production. So advance of 25,000 will be equivalent to the standard hours. Have we been given standard hours? No. That is what we are looking for. Minus actual hours. Actual hours tumeitumia hapa juu. 5760. We multiply by the standard rate, which we've calculated up here as 7,000. Which we've calculated there as 7,000. So if that is done, I need to break my bracket by taking negative 2520,000 is equal to 7,000 SH minus. So I want to take 7,000 by 5760, and then you'll be able to give me the result. 5760. How is the SR 7,000? Si ndio hii hapa ama hii ni nini? What have we calculated up here, the first one? Wani, what is this figure? Wani, what is this figure? What have we calculated the first one here? Tulikuwa tunatafuta SR. Na SR kwa formula yetu iko hapa. That's why we transfer it to that part. Is it clear now? Wani confirm. Wani confirm. Okay, so we have 320,000. 320,000. That is what we have. So let's look for SH. How are we going to do this? We basically come to, these are negative. It crosses the equal sign. So we are going to have SH is equal to this one to cross. So we are going to have 320,000. This one remains to be a negative 2520,000. The whole of that, we are going to divide by 7,000. What is our standard? Standard hours in actual production. Standard hours in actual production will be how many hours? Standard hours in actual production tutakuwa na ngapi? 5,400 hours, is it? So actual production for the finished product tuliambiwa ni ngapi? Let me see if you are able to remember. What is the actual production of this finished product? Actual production of SGM ni ngapi? Actual production of SGM. Actual production in SGM. Actual production of SGM. How many units? 1080 units. The actual hours, or I mean the standard hours that were used in that actual production is 5,400 hours. So standard hours in actual production is equal to 5,400 hours. What is the standard hours per unit of SGM? Standard hours per unit of SGM itakuwa ngapi? We take the total hours divided by the unit. So what is the hours per unit? Unachukua total hours na divide by unit, 5,400 divide by 1080 units. How many hours per unit? 5 hours. 5 hours per unit of SGM. Our interest here is to get the standard cost card of a unit of SGM. We need 5 hours. We need 5 hours of direct labor to produce 1 unit of SGA. But what is the cost per labor? What is the standard cost per labor hour? Standard cost per labor hour ni ngapi? Standard cost per labor hour or standard rate? Standard rate. Standard rate tulisema ndio hii hapa hivi. So we multiply by 7,000 at shillings 7,000. Ukifanya hivyo unapata ngapi? Multiply the two. Multiply the two. What are you getting so that you can have the exact figure now here? Tunapata ngapi hapa juu? 35,000. 35. Mtu anapata 3,500. 35,000. That is it. There's nothing else. That's what you are required. That is what you are required to calculate there. Umemalizana na direct labor. So if you're done with the direct labor, it means you can get prime. You can get prime costs. You can get prime costs. So let's go ahead and look for the variable production overheads. Let's go ahead and look for the variable production. Variable production overhead. So the variable production overheads there, basically, if you look at the question, they have given us what we call the variable expenditure variance. They have given us what we call the variable expenditure variance is what we have been given in the question. And therefore, let's come to this part and deal with the variable expenditure variance. Variable overhead expenditure variance. Variable overhead expenditure variance. Variable overhead expenditure variance. How do we calculate variable overhead expenditure variance? Variable overhead expenditure variance. How do we calculate that? It is budgeted variable overhead minus actual. So it is budgeted variable overhead. I believe you'll be able to write this in full, minus actual variable overhead. That is what we need to have. The actual variable overheads, if you're keen enough, you'll be able to see them in the question there. The budgeted variable or actual. So variable production overheads, the actual is already given. So what we need to have here now is the budgeted variable overhead. So budgeted variable overhead, that is the budgeted variable overhead, is equivalent to budgeted hours times variable overhead absorption rate. Budgeted variable overhead is equivalent to variable overhead absorption rate. We multiply by actual hours. So it depends now again with how are we distributing the direct labor? It was dependent, the cost here was dependent on the total labor hour. So the actual labor hours. That is what you need to have there. The variable overhead expenditure variance is equivalent to budgeted variable overhead minus actual variable overhead. If unapata direct from the examiner, because you are given actual results, then budgeted variable overhead is equivalent to variable overhead absorption rate. So V is basically because you are dealing with variable overheads, but overhead absorption rate, it is something that we have been using all the way from topic number 4. Now, actual labor hours, are we having that? Are we having that? Are we having the actual labor hours? That is what we need. So this budgeted variable overhead, ICO, it is what we are looking for because we are required to come up with a standard cost card of that particular company. And therefore, for us to have the variable production overhead, the budgeted ICO, it is what we are looking for. The variable overhead is what we are looking for. But do we have the actual labor hours to connive? Are we able to get the variable overhead absorption rate? Are we able to get the variable overhead absorption rate? Yes, we should be able to get the variable overhead absorption rate. We should be able to get variable overhead absorption rate. So let's go very fast. Let's go very fast to this area. Yes, the budgeted variable overhead is equal to variable overhead absorption rate times actual labor hours. What do we have out of these two? Out of all these items. So let's come to this part here. What are we given in the question? Just mention if it is actual labor hours, just mention that. If it is variable overhead absorption rate, please mention that. Please mention that so that we can understand. So that we can understand what is going on. Someone to mention that. What are we given in the question? What are we given in the question? The variable overheads. What have we been given there? Do we have the actual labor hours? Actual labor hours, 5760. Good. So I know very well that I already have times 5760. Okay, times 5760. How about variable overhead absorption rate or budgeted variable overhead? Any other thing that you have been given there in the question? Let me check. Any other thing that you have been given there? Any other thing that you have been given there? Any other thing that you have been given there? Variable overhead. Haya, variable overhead ni ngapi? Variable overhead yenye tumepewa ni ngapi? Variable overhead yenye tumepewa hapo ni ngapi? That is actual variable overhead. So within this part only, within this part, hii ya kwanza, budgeted variable overhead. Ndio hii sasa tunatafuta. Are we able to get something close to that? Look at the variances given there. Look at the variances given to us there. Are you able to get something? Are you able to get something? Are you able to get something? What one has how? Okay, I've been given something that is 12,096,000. So come here, come here. Do you have this element? Do you have this element? Variable overhead expenditure variance. Tumepewa. If yes, what is the figure? If yes, what is the figure? If yes, what is the figure? What is our variable overhead expenditure variance? 900 advance ama sasa mtu ako na 900, mtu ako na 576. Tufuate nani? Tufuate nani? Wacha tuangalie mwenye sasa anatupotosha hapa. Fixed overhead expenditure variance 900. Variable overhead expenditure variance 576 adverse. Are we looking at the same question really? Florence, are we looking at the same question? Night, are we having the same question? Are we having the same question? Okay, so the variable overhead expenditure variance is negative 576,000. Negative 576,000 is equivalent to budgeted variable overhead, minus actual variable overheads. Actual variable overheads we have been given there is equivalent to 12,096,000. That is what you have been given. Let me just take it this way. That is what you have been given. So by just look at what we have here, are you able to get now the budgeted variable overheads? Are you able to get budgeted variable overheads? This unknown. Go ahead and give me the figure. So budgeted variable overhead is equivalent to is equivalent to 12,096,000, 12,096. Yes, 12,096. So you're going to have this one causes the equal sign to be a positive 12,096,000 minus 576,000. Tukifanya hivyo, what is budgeted variable overhead? Budgeted variable overhead ni ngapi? Budgeted variable overhead tumepewa hapo sasa ni ngapi? Let's calculate it very fast, please. Tumeshindwa kupata difference between these two. 12,096 minus 576. Is it not 12, 12, 12, 12, 12, 12, 12, 11? 11,520. 11,520. Nasi tuko hapa. Budgeted variable overhead is equal to variable overhead absorption rate times actual labor hours. Tuko na actual labor hours. Hii variable overhead absorption rate hatuna. So unaona sasa, we don't have this. Or let me bring it down here for someone to be able to follow through. And I really need the labor items. Let me see if I can complete it down here. So this is what we have. We are lacking what we call budgeted variable overhead. And tumesema budgeted variable overhead is equal to this. We cannot have two unknowns. We cannot lack budgeted variable overheads and again lack variable overhead absorption rate at the same time. That's why we follow the other procedure to arrive at variable overhead absorption rate, the budgeted, which is 11,520,000. 11,520,000 is equal to variable overhead absorption rate times this. How do we get VOR? So variable overhead absorption rate is equivalent to 11,520 we divide by 5760. 5760. Tunapata ngapi hapa? Tunapata ngapi? Variable overhead absorption rate. Variable overhead absorption rate tunapata ngapi? Variable overhead absorption rate tunapata ngapi? Tunapata 2,000. Tunapata shillings. 2,000 per labor hour. Is it? It is 2,000 per direct. It is 2,000 per direct labor hour. It is 2,000 per direct labor hour. So that is what we have. The variable overhead production, variable production overhead is equivalent to variable overhead absorption rate times standard hours. Times standard hours. So do we have the variable overhead absorption rate? Yes, we have it. It is 2,000 shillings per hour. So let's get the labor hours. The direct labor hours as per the standard is 5 hours at shillings 2,000. Are you able to remember when we were doing, was it still topic number 7? We were able to see these elements. Tulichukulia tu kwa standard cost cut, tukasema this is the variable, this is the overhead absorption rate. This is the overhead absorption rate, tukamultiply na the actual hours. So the same thing, hii ndio tunatafuta hii standard. Tukishapata standard or overhead absorption rate, it is 2,000, we multiply by their standard hours to give us what figure here? Tunapata ngapi hapa? 10,000. Sasa kuja chini hapa uweke 10,000. Kuja hapo uweke 10,000. Kuja hapo uweke 10,000. Then I want you to do the same for me by looking at, do the same. If you are dealing with overheads, we're going to look at the labor hours. The labor hours will be guiding you. So the next thing, we need to look at fixed overhead expenditure variance. Fixed overhead expenditure variance. Fixed overhead expenditure variance. So the fixed overhead expenditure variance, our fixed overhead hiki tuna float. Umepotea wapi? Boni ni wapi hauelewi kabisa? Boni ni wapi hauelewi? Tulisema when you're going to do what we call absorption of overheads. The absorption of overheads, tulisema in a question, one, you can use direct material to apportion the overhead, that's the direct material cost, the cost of direct material. Two, you can use direct labor hours. Three, you can use machine hours. The direct labor or direct material here, direct material, you're going to use the cost. So you cannot tell us that you're going to apply the units. Here, you give us the percentage. Here, you're going to give us the percentage. Direct labor hour, then machine hours, you're basically going to apply. You're going to use hours to get the absorption rate. Overhead absorption rate. I've not mentioned variable, I've not mentioned fixed. I've just said overhead absorption rate is equivalent to total overheads to be apportioned or budgeted, if it is as per the budgeted overheads divided by budgeted activity level. Here, we don't have anything close to machine hours. We don't have anything close to machine hours. Then, we are able to see the only thing we are having here is direct labor hours. So here, these variables are going to be absorbed based on the direct labor hours. That's why we are using here budgeted labor hours. The budgeted labor hours, after getting the overhead absorption rate, we multiply by the actual activity level, which happen to be actual labor hours. This overhead absorption rate, for us to get the budgeted overheads that were absorbed, budgeted overheads absorbed is equal to overhead absorption rate times actual labor hours. Tumekuja hapa, budgeted variable overheads is equal to variable overhead absorption rate times actual labor hours. The only thing we are adding here is V, because we are dealing with variable overheads. Ukiweka hiki to the all of this is what you are using here. Is what you are actually using here. Now that we've been able to see how the formula is coming to exist, when we reach down here, we are not able to get the variable overhead absorption rate, and we are also not able to get the variable or budgeted variable overhead. We cannot have two unknowns in a question, and that's why we had to use another route to get one of the unknowns. If you look at our question up here, the variable overhead expenditure variance is equal to budgeted variable overhead minus actual variable overhead. In our question, the examiner has given us the variances, the examiner has given us the actual results. What is the unknown? This is the unknown. This one here is the unknown. So that's why we went back again now to look for this unknown first of all. And we've been able to get that unknown down here. The budgeted variable overhead has been calculated and we were able to arrive at this figure. Back to our question where we get the two unknowns. When we are now able to get the budgeted variable overhead, we'll remain with one unknown, which is variable overhead absorption rate. If you work out this very well, we are able to arrive at variable overhead absorption rate of 2,000 per hour. Coming up to your question, the variable overhead absorption rate we have said is dependent on direct labor hours. It is absorbed based on direct labor hours. How many direct labor hours do we need to produce 1 unit of SGM as per the standard costing system? We were able to get that direct labor hours needed as per the standard cost card is 5 hours. When I take 5 hours, multiply by variable overhead absorption rate, I'm getting the budgeted variable production overhead per unit. Is it now clear? Is it now clear? Is it now clear? Okay, Flores, that one you're going to use if the examiner was so specific and said for the variable production overhead, it is not going to depend on this one. Kama angekwambia directly that the budgeted variable overheads is not 5 hours. Ungeambiwa hapa ni 7, ungeambiwa hapa ni 7, ungeambiwa hapa ni 7. You don't even, this one here we are supposed to calculate. So if they could have told you that the variable production overheads do not directly depend on this, and you are given a specific item, then you use that to calculate, use that to arrive at this part here. Use that to arrive at this part. But because the examiner is silent about that, we take the direct labor hours to be also the hours under variable production overhead. To be the variable overhead, the total hours as per the standard to produce 1 unit of SGM. That's why we have used these 5 hours. Let's go to fixed production overhead. Let's go to fixed production overhead. So the fixed overhead expenditure variance. Fixed overhead expenditure variance. Our next question, I think, will be touching on that, Flora. So let's get to this. Fixed overhead expenditure variance. Fixed overhead expenditure variance. Are we able to get that? Fixed overhead expenditure variance will be equivalent to, it is the same thing, budgeted fixed overhead minus actual fixed overhead. Budgeted fixed overhead minus actual. Minus actual fixed overhead. Good. Do we have actual fixed overhead within the question? Do we have fixed overhead expenditure variance? Do we have budgeted fixed overhead? Do we have any of these items here? If yes, let's look at the question and see what we have been given. The fixed overhead expenditure variance, the fixed overhead expenditure variance is 900 favorable. So 900 favorable, that is positive, is equivalent to budgeted fixed overhead, which we are actually looking for, minus actual fixed overheads, which is 48,600,000. That's what we have. So let's go ahead and look for the budgeted fixed overhead. Tunapata ngapi? Budgeted fixed overhead tunapata ngapi? Budgeted fixed overhead tunapata ngapi? Budgeted fixed overhead tunapata ngapi? Budgeted fixed overhead. The difference between 48,600 and 900,000 tunapata ngapi? Naitaangalia vizuri. The figures they are given in thousands, and 48,600 is also given in thousands. So angalia vizuri please. Angalia vizuri. What do you have there? What do you have there? We add. Hii ni negative, ikikuja huku inakuwa nini? Inakuwa positive. So this one here plus 900,000. Tunapata ngapi? It must be more than 48,600,000. Ukipata anything less than this, you are too umekosea. So it is 49,500,000. Budgeted fixed overhead. Budgeted fixed overhead is equal to fixed overhead absorption rate times actual labor hours. That is what we have. So do we have any of these three? Yes, the budgeted fixed overhead sharp at 49,500,000 is equal to fixed overhead absorption rate. We are not having it. We multiply by actual labor hours. actual labor hours ilikuwa ngapi? Actual labor hours ilikuwa ngapi? 57:60. So let's look for fixed overhead absorption rate. Fixed overhead absorption rate, nachukua the whole of this, I divide by 57:60. Inakuwa ngapi? Ndio nikuja hapa nichukue hiyo 4 multiplied by actual labor hours, which as per the standard for one particular unit of SGM it is 5 hours. Tunapata ngapi hapa? Tunapata ngapi? 85.94. 85.94. Okay, we are round off mapema sana. I think that person will confirm that. Let's see at least 2 people giving their responses there so that we pick a more reliable answer. 3 decimal places, jaribu 3 decimal places. Itatupatia hii without anything remaining out, is it? It will give us this without anything remaining out. Great. So we've been able to get 4. So that 4 fixed overhead absorption rate, you multiply by the standard, multiply by the standard hours of the actual hours. Sasa unakuja hapa, hiyo 4 ndio hii at shillings. Si tumepata hii fixed overhead absorption rate is in shillings per direct labor hour. Tunakuja hapa ndio hiyo 85.93.75 na hapa tuko na 5 hours. So hapa tunapata ngapi? What are we getting this side? What are we getting that other side? What are we getting that other side? What are we getting that other side? Mtu achangamke mbio ndio tuendelee. Ndio tumalize hii story leo. Ndio sasa watu wabaki na kasi. Ndio sasa watu wabaki na kasi. If you multiply by 5, what are you getting? If you multiply that by 5, what are you getting? If you multiply that by 5, what are you getting? If that is multiplied by 5, what are people going to get? What are we going to have? 49, 49, 42, 968, 42. 42,968.75. Standard cost card of a unit of SGM. Haya, kuja hapa chini nipatie total. What do you have? Alafu just prove 1. Tunataka kuprove 2 moja. Nipatie total, then we now prove. We confirm whether what you are having here are really okay or we are doing our own things. Tunapata ngapi? 968. 968.75. So that is the standard cost card of 1 unit of SGM. That's the standard cost card of 1 unit of SGM. In exams, I want us to assume the only thing you're going to give me here is the budgeted units of SGM. Wali budget how many units? As per their budget, walisema SGM itakuwa how many units? As per their budget, walisema SGM itakuwa how many units? Budgeted production walisema ni ngapi? Budgeted production. Hiyo ni actual jameni. Soma number 3 vizuri. Hiyo ni actual ama budgeted? Hiyo ni actual ama budgeted? Niambie specific place where they have indicated budgeted. Ni sasa watu wanakosea hapa sana. Budgeted tumepewa. Mimi nimeitisha budgeted, sio actual. Sasa juu watu hawaoni budgeted wananipatia actual. They have decided to give me actual. But anyway, it's okay. It is okay. It is okay. Let's look at one of the items there. Oh. So I want you to look at what you are doing there when you are calculating all this. When you are calculating all this direct material, you are able to get the cost per unit of direct material is 10,000 and 1 kg of direct material is 10,000. But 1 kg enables us to produce SGM. So let's come maybe to which one? Let me see. Direct material rate variance is equal to standard rate minus actual rate. Then to that you multiply by actual quantity. Haya, sasa tuendelee tuone standard rate of direct material ni ngapi? Standard rate 1 unit of direct material ni ngapi? 1 unit of direct material as per the standard. Sasa hii ndio budgeted. This is the budgeted. Chukua hii budgeted, compare na actual. Forget about the variances that are given there. Sema variances aziko kabisa. What is the standard rate? Mtu ananiambia 7,000. Really? Umetoa 7,000 wapi sasa? Standard rate, si tuko na hii standard cost card. Direct material 1 kg. At what price per kg? 10,000. Hii ndio tulitumia. Watu wanasahau hizi vitu haraka sana. Na hii sasa question ni lazima ikuje. Actual rate. What was the actual rate per unit of direct labor? 1 kg. 1 kg of direct material, sorry, 1 kg of material. 1 kg of this material, the actual, give me actual. Actual rate ni ngapi? Actual rate. There is no way they are going to give you that directly. You have to calculate. You take the total cost of raw material minus the quantity of raw material that was, divide by quantity of raw material which was purchased. Unapata ngapi? It is 11,286,000 divided by 1188. Unapata 9,500. Is it? 9,500. That is our formula. Direct material rate variance is equal to standard rate, which is 10,000 to calculate pale, minus actual rate 9,500. To this you multiply by actual quantity. What is the actual quantity of raw material? Ni ngapi? Actual quantity of raw material tumepewa hapo ni ngapi? Lazima upewe, ulipewa. The only thing we are now eliminating variances. Just assume that these variances hata sijaionekana. Weka screen yako ifike tu hapo kwa actual. Standard ndio nimekuweka kwa board. So tumia standard, tumia actual. Tusonge mbele. 1188. So, can you give me direct material rate variance? Tunapata ngapi? Direct material rate variance unapata ngapi? Uliweka standard that you are going to buy raw materials at 10,000 per unit. You went to the market and ended up purchasing them at 9,500. Are you losing or gaining? We are gaining. So if it is a gain, just give me the answer there. 594,000. 594,000 favorable. Aya, enda kwa list ya variances. Uangalie direct material rate variance. Niambie the figure there. Ni ngapi? Direct material rate variance kwa list ya variances. Ensure that you're able even to identify the sign, either favorable or adverse. Look at what you have there under variances and what we have here when we calculate backwards. Are they really the same? Are they the same and equal? Haya, wacha tujaribu na hii ya mwisho. Direct material usage variance. Direct material usage variance is equal to is equal to standard quantity in actual production, standard quantity in actual production minus actual quantity. Then this one here you multiply by the standard rate. Now, standard quantity in actual production, standard quantity to after direct material. We need 1 kg to produce 1 unit of SGM. So standard quantity is equal to 1 kg times actual production of the finished product SGM. What is our actual production of SGM? Actual production of SGM ni ngapi? Actual production ni 1080. Ukifanya hivyo, this one here you're going to compare with actual quantity. What is the actual quantity of raw material which was utilized? Actual quantity of raw material ni ngapi? 1188. Aya, nipatie answer hapa. 1 times 1080 ni 1080. Is it? In your budget, as per your standard hapa juu, ulisema you are going to spend, if you multiply this, you are going to have the same figure, 1080. You are going to spend 1080 kgs to produce this SGM. You ended up using 1188. Did you spend more or less? Did you spend more or less? You spent more, is it? So what is that? You spent more than what you anticipated. So it is adverse. Good. After getting that, so go ahead and give me standard rate. Direct material iko hapa. 1 kg of that direct material is 10,000. So my standard rate is 10,000. Aya, go ahead and give me direct material usage variance. Nimejua the figure ni adverse. So what is the figure? Status adverse. What is the figure? 1080,000. 1080,000 adverse. 1080,000. Aya, I want you to go to the variances table. Angalia direct material usage variance. Niambie what the figure is. The figure for direct material usage variance. Are you getting something close to this? Are you getting something close to this on that table? The variances list. The variances list. So that's how you should be able to calculate these things and even compare whether you are right or not. You are able to see wakifeature standard cost card na wametupatia variances na actual results, we can get the standard cost card. Wakitupatia standard cost card na actual results, hiyo variances list tunaweza wapatia. So that's how you deal with that particular question. We said you have standard costs and actual activities. With these two, you'll be able to get the variances, whether adverse or favorable. So if you have the three, there is no question. But if they just eliminate one from this list, you'll be able to they'll be able to have a question to bring to you. So if they add the standard cost, you're able to use variances and actual results to get the standard cost card. If they give you standard cost card and actual results, you'll be able to arrive at the variances. And that one we have proved by coming to get the standard cost card and even working backwards to generate now the variances list. So I believe that is it. That is it for that question. That is it for that particular question. That is it for that particular question. So nataka tuangalie multiple raw material. We are given that these different raw materials are going to be used to produce the same product. Different quantities or types of raw material will be used in different proportions to produce the same finished product. So how will we get the variances for in that case? So to get to understand that particular concept, let's get to our cut 2. Let's get to our cut 2. You have a question there. Our Cat 2 has got a question which will enable us to cover that concept. So let's get to Cat 2 very fast. Let's get to Cat 2. Let's get to Cat 2. And I believe none of us here is not having that Cat 2 with them. Forget about even to have. Hakuna mwenye hajapitia hiyo Cat 2, because kama hujapitia, you've decided to remain behind kidogo. You've decided to remain behind kidogo. Let's get to Cat 2 very fast, please. Ndio tuone kama time will allow to proceed to something. Cat 2, tumeipata. Tumepata Cat 2. I believe no one joined after that cat was administered, so kila mtu ako nayo. Actually, the last time I shared that cat is Wednesday. And if I check this list very well, no one joined between Wednesday and today. So if that is the case, kila mtu ako na hiyo Cat 2. Good. So Cat 2, I think it was question number. Which number is this? Which number was the question? Question number B, question 4B. So let's get to that point. Cat 2, question 4. Cat 2, question 4B. Question 4B, Cat 2. Question 4B, Cat 2. We are being told there that Rama Limited is a cake baking firm. It produces a special blend for cake known as Utapia blend by mixing 2 grades of flour, that is B and Q, as follows. Material, standard mix ratio, then standard price per kg. Sasa hapa tumepewa standards. Kwa hivyo, there's high chances you're going to be required to calculate the variances. Now, after getting the standard loss of 15% is expected. During the month of March 2002, the company produced 2,500 kgs of Utapia blend. The actual quantities blended, were as follows. Quantity used, then the cost. Sasa hapo ukiangalia vizuri, mtu ata confuse. The first table there, you are given standard price per kg. In the second table, amejua watu wamefanya nini, wamecram. You've been given the total cost. You cannot compare total cost and the cost per unit. You have to convert one of them to match the other. That is it. So what are you required to do? Required, calculate the following variances. Nothing has changed. We are still working on the direct material, but this is what you are going to do. Direct material now, here they are going to give you material, direct material price variance. You are supposed to calculate, actually it starts from this point. Direct material cost variance is equal to direct material price variance plus direct material usage variance. But now, direct material usage variance is divided into 2. Direct material yield variance plus direct material mix variance. Direct material mix variance. So that's what we have there. That is what we have there. Direct material cost is basically price and usage. But usage here has been divided into two because remember we are dealing with two different types of raw materials. So we are going to look at the direct material yield. What were they able to yield at the end of this particular process? Because they are also bringing in a concept of normal. If you are keen enough, you'll be able to see we have a concept of normal, loss. Unaona wameifix hapo ndani. Then direct material mix variance. Why are we bringing direct material mix variance? Because we are using two different types of raw materials. That's why this one here is necessary. In the other questions that we have been tackling, we are not given different raw materials. So therefore, the mixing ratio there was not actually relevant. It's just one particular raw material. So this question here is going to be the simplest and the easiest of all. The simplest and the easiest of all. So let's go to that question and see what we have been given there. The first thing we are required to get material price variance. Nothing has changed. What is happening is this. Direct material price variance is equal to, we are comparing the prices. Is it? You come here and give us the standard price, you less actual price. And if you can recall, what were we putting outside here? What were we putting outside here when you're comparing the price? So what we multiply na nini? Actual quantity, is it? So the only thing I'm going to do, imagine, look at what we are adding. Actual usage in actual mix. Actual usage in actual mix. The other one was actual quantity. It was actual quantity because there's nothing like mixing them in a given ratio. There was nothing like normal loss. No, that one was not there. But now when we come to this part, there's that percentage that is normally lost. And we are also going to mix them in a given ratio. And therefore we expect the output to be also appear in a given ratio. So that's why we are replacing actual quantity with this term, only that, and you are done. So let's come down here and see. Another thing that you're also able to understand, this one here, direct material price variance, we are not dealing with one item. We are dealing with two different types of raw material. Actual usage in actual mix. Actual usage in actual mix. Actual usage in actual mix. Good. So let's come down here. You are able to see we have different types of raw materials, and we have the prices here. So you're going to compare the price for each raw material. What do I need to do? Come and put here detail. Then you put here the standard price, actual price. Give us here the difference. And what are you doing? Actual usage in actual mix. Having done that, you come here and give us now the variance, which is direct material price variance. We are dealing with which materials? We are dealing with the BK. We are dealing with QM. So BK, what is the standard price? Standard price tumepewa hapo juu. Standard price of BK is 120. And QM is 100. I believe you're able to see that. What about actual price? Tumepewa quantity used na quantity or the total cost. So what are you supposed to do? You take 175,000, you divide by 1,400. Tunapata ngapi hapa? 175,000 divided by 1,400. 175,000 divided by 1,400, 125. Okay, the other one, 152,000 divided by 1,600. Tunapata ngapi? Tunapata ngapi? 152,000 divided by that, tunapata 95. 95. The same argument applies here. You stated as per your standard that you're going to purchase this raw material at 120. You ended up purchasing it at 125. Ni loss ama ni gain? Ni loss ama ni gain? Ni loss ama ni gain? Ni loss. Now, tukisema loss is basically adverse. So the difference between these two, I can see is 5A. 5A. Good. Let's come to QM. You budgeted 100, but you ended up purchasing it at 95. Is it gain or loss? Favorable. Is it of how much? Of 5? Of 5 shillings. That is favorable. Whatever we've taken here is the price per unit. Is it? Is the price per unit of BK 120, price per unit of QM 100. Tunaelewana? Let's come to actual usage in actual mix. If you look at what they said, down up there. Walisema, as per the standard, direct material, BK itachukua what percent? 40%. QM itachukua what percent? Itachukua 60%. Is it? That is as per the standard. So that whatever is there as per the standard is not supposed to be used here. Upon actual usage in actual mix. What did they actually use? Achana standard. What did they actually use for BK? And what was used for QM in terms of upon quantity? Unaona hapo uliandika AQ, actual quantity. So how many units of BK were used? Enda kwa actual results uniambie how many units of BK were used? 1,400. How many units of QM were used? How many units? 1,600. Good. You've already gotten the difference here. Kazi yako ni multiply by quantity to get the cumulative amount. So 5 by 1,400 itakuwa ngapi? 5 by 1,400 7,000. Bora ume-identify hii sign hapa, we transfer it to this part. Then 5 by 1,600. 5 by 1,600 itakuwa ngapi? Favorable, is it? Favorable. Sasa hapa unaanza kufikiria vitu mingi. Ulikuwa na negative 7,000 plus 8,000. Unakuwa na positive ama negative? Unakuwa na positive ama negative? Positive 1,000. And remember positive ni favorable. So that's what you are required to do there. That is what you are required to do. Imagine just doing that simple thing you are done with the first part of the question. You are done with the first part of the question. Let's go to the second part, which we are being told. We are being told to do what? To calculate material usage variance. Material usage variance cannot be calculated directly. In the other concept, let's just compare, then you're going to understand the meaning. Material usage variance was equal to standard quantity in actual production minus standard quantity in actual production minus actual quantity. Then all of this you multiply by standard price. See, tumeona hiyo kitu. This is what we are doing the other time, is it? Actual production. Are you able to see that? This is what we are applying in the other question. But now here, the usage has been divided into two. We have to look at the yields. Yes, we used that quantity of raw material, but did it give us what you actually anticipated? we have to look at the mix. How was it mixed? As per the standard, what was there that was mixed? So material usage variance, we are going to deal with material yield and then material mix. So let's start with material mix or yield. Any of them can work. So let's start with material yield. Material yield is taking you to calculating something. We can look at direct material mix variance. So direct material mixed variance, we are mixing them, is it? So if you're going to mix these materials, you compare the actual usage in actual mix and actual usage in standard mix. Tunaelewana? Material mix variance, it is actual usage in actual mix and standard usage or actual usage in standard mix. Tumepata real results. What you're going to do here is basically, as per the standard, walisema wanatumia ngapi. Then, as per the actual results, did they use them in that proportion? That's what you're going to look at. That's what we are going to look at. So this is the simplest thing again. You come here and give us, we have to look at the actual usage in standard mix minus actual usage in actual mix. The whole of this, anything you're going to calculate after getting the rates, you multiply by the standard price. You multiply by the standard price. Sasa tunakuja hapa, tuangalie hii kwanza, actual usage in standard mix. Actual usage in actual mix ndio hii. Tumepata walitumia what quantity of how many kgs of these raw materials? Walitumia 1,400, wakatumia 1,600. So that is a total of 3. That is the actual results. Walitumia 3,000. But this 3,000, walitumia 1,400 for BK, wakatumia 1,600 for QM. That is the actual result. Sio kwa standard. Now assume they were mixed. Yes, the actual result total here is 3,000. But what is the mixture? Or this, as per the standard, how are they mixing these things? Were they mixed based on, are they going to be as per the standard or things are going to change? Because if the total used is 3,000, let's see, total used is 3,000. Now walisema BK itachukua what percent? 40%. Is it? BK itachukua 40%. I think that is what we have there. Yes. And then QM itachukua 60%. QM itachukua 60%. So you come to the question and ask yourself, is that the case? Let's come and see. So what we are basically going to calculate here, the actual amount which was used is 3,000 kgs. But you want to look at what is the standard mix in the actual result. Actual usage in standard mix. That's what we are looking for. Walitumia actual results, 3,000 kgs. Now look at that actual usage based on the standard mix ratio. So BK will take 40% of 3,000. Tunapata ngapi? And then QM will take 60% of 3,000. That's what they said. If they are going to actually use 3,000, then that's the proportion of sharing those particular costs. So is that the case? So here I have 1,200 kgs. How about the second one? Mtu napata 46.67 wapi? 46.67 tumetoa wapi Boni? 46.67 tumetoa wapi? Boni angalia vizuri. Rama Limited is a cake baking. Angalia hapo chini. Then that is B and Q as follows. Standard mix ratio. Boni angalia hapo before tuendelee. I want Boni to respond that ameona chenye tunafanya. $1,000 as a percentage of Angalia hapo hivyo before ufike kwa hii 1,400. What is the title of what is there? The actual quantities blended were as follows. The actual quantities blended were as follows. These are the actual. But we are looking for the, yes, it is actual usage, but based on the standard mix. Walisema, anytime you're going to do production, BK will be taking 40% of what's supposed to be utilized. QM will be taking 60% of what's supposed to be utilized. Ukiangalia what was utilized ni 3,000. Is it? Now, if you apportion these things based on the standard here, you take 40 of 3,000, you take 60 of 3,000. Tunapata 1,800. 1,800. So unaanza kujiuliza, as per the standard, the actual which is supposed to be used, walisema BK itachukua 1,200 kama total ni 3,000, lakini BK imechukua 1,400. So is it excess or less? Wamechukua more than what was anticipated. That is a adverse. Ukikuja hapa walisema as per the standard, the actual used is supposed to be 1,800. Ukikuja hapa ni 1,600. That is favorable. That is favorable. So that is what we are going to do down here. And now that we've been able to identify this, tukuje hapa, it does not change. It does not change so much. That is what we are going to have there. So you give us details. You give us now the actual usage in standard mix, actual usage in actual mix, then you multiply by the standard price. So we get the difference, standard price, and then direct material mix variance. We have BK, we have QM. BK actual usage in standard mix to make calculate hapa sisi wote 1,200, 1,800. Actual usage in actual mix, it is 1,400, 1,600. Anytime you are going to calculate direct material mix variance, alafu upate hapa hivi ukijaribu ku-add, they are not equal. Jua tu umekosea. They must be. Because what you are basically looking at, this is the result, but you are trying to look at it based on the standard proportion. So it's still going to be the same thing. It will be the same thing. Now, having done that, look at the difference. Ulisema unatumia 1,200, ukatumia 1,400. That is excess by 2,000. And that excess is not good at all. So it's going to be adverse. Ulisema unatumia 1,800, ukatumia 1,600. That less is very, very nice for these people. That is favorable. Standard price tulitumia somewhere. It does not change. 100. If you work on this one here, what are you getting? 200 by 120, unapata ngapi? Is it 24,000? 200 by 120, unapata ngapi? 200 by 120, unapata ngapi? Tunapata ngapi hapa? 24,000. 200 by 100, that is of course adverse. Alafu hapa tunakuwa na 20,000 favorable. What is the net effect? Net effect ni ngapi? Net effect ni ngapi? Net effect, watu wameshindwa kupata net effect. Really? Watu wameshindwa kupata net effect? 4,000? How? Oscar, uko na deni ya 24,000. Umelipa 20,000. Umelipa 20,000. Bado uko na deni ama umemaliza deni? Okay. The next question there we are told to get material yield variance. Material yield, direct material yield variance. Here, you are basically dealing with the output of material used, the material that was used to do the production, was it really maximized? How efficient is the company in terms of utilizing the raw material? Were they able to maximize? Were they able to minimize the wastage? So, number one, we'll be able to see we have normal loss of what percent? They normally allow, if they bring this given of quantity of raw material, they expect a normal loss of what percent? 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 Kuna mwenye hata audio normal loss anasema kwani tumerudi topic 6. Kuna mwenye aoni hata hiyo 15% iko wapi? Na tuko na yeye hapa tu. Na amekuwa na marking scheme na question na kati yote. This is what we are dealing with. Direct material yield variance. Direct material yield variance. Direct material yield variance. That's what we are dealing with. Tumeambiwa something there that after the standard mix ratio of 40 and 60%, chini yake tumeambiwa a standard loss is expected. Hata waseme standard loss, hata waseme normal loss, they still mean the same thing. A standard loss of 15% is expected anytime they bring in a given quantity of raw material, they must lose 15%. 15% is normally lost, maybe due to evaporation or spillage. Now, if you are able to see what is given there, the actual quantities blended were as follows. If you look at what we have there, let's see what we have there. As per the standard, we are given the actual results as 1,400, 1,600. Normal loss is allowed, but actual results, the actual quantity that you're able to see at the end of the day, this one here, tunapata ni ngapi? 3,000. Actual usage in actual mix, tunapata ni ngapi? 3,000. Now, my question is, we have normal loss, then this is expected output. Expected output ni ngapi? Expected output ni ngapi? Expected output ni ngapi? Expected output. Expected output. Unaleta 100% ndani. 15% unapoteza. What do you expect? What do you expect? Mtu ananiambia expected ni 3,000 kgs. Really? 3,000 ni actual. Hiyo ni actual. That is the actual. 85%. Now, you expect 85%. Yes. You expect 85%. And Boni, that's what you expect after getting away or deducting the normal loss. Now, if you add all these two, you're going to get 100% and 10%. And Boni is right. He was not giving us the percentage, but now this is the normal loss. Now I want to get this in terms of kg. Are you able to give me the 15%? Or are you able to give me 85%? Nataka tuona sasa kama tunaelewa hizi vitu. Are you able to give me? So what does 15% represent in terms of kgs, or what does 85% represent in terms of kg? The actual. Boni sasa wewe una guess. Boni ana guess hizi vitu. Hapo unasikianga shetani ametangulia na unamfuata. Unatoka kwa correct answer, unafuata shetani. Anakwambia hapana, wachana na hiyo 3,000. Achana hiyo 3,000. Sasa watu wamekosea. Let me ask you, have you been given the quantity that was brought in as per the standard? Hii 3,000 yenye tumepewa hapo hivyo, is it the standard or the actual? Is it the standard or the actual? Wacha tuelewane hapo kwanza. 3,000 yenye tumepata. Is it the standard or the actual? Actual ni 3,000, is it? So what you expect, this one here, expected of course is going to be the actual. In this particular case, it is the actual. It is the actual that you're going to expect. So you expected, anytime you bring in raw material, you lose 15%, you remain with 85%. Walipoteza 15%, ndio maana wakabaki na 3,000 at the end of it. Walibaki na 3,000. Hiyo 3,000 ndio iko hapa hivi. Hiyo 3,000 ndio iko wapi? Ndio hiyo iko hapo. Kama umepewa 3,000, umesema ni actual ama expected. Are you able to go ahead and give us what we are lacking here? Because this is what we are lacking. Hiyo X tuna lack because when you come to direct material yield variance is equivalent to standard usage in standard mix minus actual usage in standard mix, then the whole of this you multiply by the standard price. Actual usage in standard mix, tuko naye hapa ndio hii. Actual usage in standard mix. What you are now lacking is standard usage in standard mix. What did they bring in? Do you relate one? Raw material brought in ni 100%. Wanaleta 100%, wanapoteza 15, wanapata 85%. Walipata 85%, 3,000. What are we looking for? What will be the value of X? What will be the value of X? That's the standard raw material which was brought in. Well. Have we been given the actual results? The only thing that's happening there is, remember we are not in topic number 6, but let's take it from this point. We don't have abnormal gain or abnormal loss thing. No. Here, when you bring in raw material, unajua, zingine zitabaki, zingine evaporate. So you always say that anytime I bring in 10,000 kgs, 10% huwa inapotea. At the end of the production, umepata 3,000. Hii 3,000, ile 10% ilishapotea. Hii 3,000, ulishapoteza 15%. The question is, how many kgs did you bring in for you to remain with the 3,000 as the final result? You brought in 100%. Ukapoteza 15. Ukabaki na 85. Hii 85 ndio hii 3,000. Now my question is, what did you bring in? What did you bring in? You brought 85% is equal to 3,000. But you brought in 100%. Itakuwa ngapi? Anything less than 3,000, that is 0. Weka 0 hapo ndio tuendelee. Anything less than 3,000, weka 0 alafu tuendelee. 35, 29.4112. Okay. What are we required to get here? Standard usage in standard mix. This is what was brought in. If you brought in this quantity here, your standard says that for BK, you are supposed to use 40% of what is brought in. So 40% of 3529.4112. Then QM, you are supposed to use 60% of what is brought in. So what are you going to have here? 40% of this ni ngapi? 40% of this, we cannot even put it to the nearest whole number to that point. 40% of E to the nearest whole number ni ngapi? 40% of that to the nearest whole number. $14.12. How about 60% of this? So we are losing 15% before production of the blend. You are told that the standard loss is always 15%. Actual usage in actual mix. Angalia hapo place ya actual results. Tumeona vizuri. Actual results tumepata ni 1,400 for BK, 1,600 for QM. Actual result tukapata ni 3,000. Tumeambiwa that normally as per their standard they're supposed to lose 15%. Kwa hivyo they brought in X or they brought in 100%, hatujui 100%, wakapoteza 15%, hatujui hiyo 15%, wakabaki na 85%. This is the actual result they are getting. 85% tumeambiwa hapa actual usage and actual mix ni 3,000. You are remaining with the actual one, 85%. Kumbe ulileta ngapi hapa? 100% itakuwa ngapi? You brought in 100%, ulipoteza 15, ukabaki na 85. Umeambiwa 85 yenye imebaki is the same as 3,000. Are you able to calculate backwards to give us X? What are you able to do that now? Are you able to do that? 21:18. 21:18. So do we have this in place? Do we have this now? Having done that, we now come to direct material yields variance. Standard usage in standard mix. Ndio hii tumecalculate hapa. Ndio hii hapa. Standard usage in standard mix. Actual usage in standard mix. Tuko nayo hapa. So what are we going to do? I will come here and indicate direct material yield variance. I just change this table. So I'll take this one to be my standard usage in standard mix. I take this one to be my actual usage in standard mix. I get the difference, then I get the standard price. Standard price does not change. Ni hiyo tu 120. So that is what we are going to have there. Standard usage in standard mix to make calculate hapa. Tuko na 14, 12, tuko na 21, 18. Actual usage in standard mix tuko nayo hapa chini. 1,200, 1,800. Difference. I budgeted to mix these products in what proportion? I budgeted to take 1412. I budgeted to bring 1412. I've ended up utilizing 1,200. Is it a gain or a loss? Is it a gain or a loss? Is a gain. So give me the difference between these two. The difference itakuwa to 12, is it? The difference between these two, I expected to use 2118 to produce the product, but I ended up using 1,800 only. It is a gain of how much? 318 gain. Go ahead and calculate. Standard price is 120 and 100. 212 by 120 itakuwa ngapi? 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 Somebody. Itakuwa ngapi? 25 for 40. Favorable. Good. You've done everything there. Now, give us direct material price variance. Tulipata ngapi? Was it 1,000 favorable or adverse? Was it 1,000 favorable or adverse? Yes, give me that. Was it 1,000 favorable or adverse? Direct material price variance. Ilikuwa ngapi? Direct material price variance ilikuwa ngapi? Direct material price variance. Or in your 25 or 40 favorable. So give me the total then. Give me the total. $447 to 40 favorable. So I'm told this one was 1,000 favorable. Then after direct material, you come to direct material usage variance. This direct material usage variance is basically equivalent to direct material mix variance plus direct material yield variance. Direct material mix variance is 4,000 adverse. Direct material yield variance is equivalent to 447 to 40 favorable. Ukiongeza hizi utapata ngapi tuweke huku? I know it will be favorable. This one is higher than the other one. It will be favorable. Confirm if you are getting 443 to 40. Confirm if you are getting 443 to 40 favorable. Confirm if you are getting 443. Well. Haya, sasa wacha tutoe hizi vitu juu sasa watu wameshindwa kupata hesabu. Take 212 by 120, uniambie unapata ngapi? Forget about the sign. 212 by 120 ni ngapi? 212 by 120 ni ngapi? 25,440. Take 318 by 100 ni ngapi? Add these two items. What are you getting? Anything less than 56 is wrong. Anything less than 56 is wrong. So what is the figure? So direct material mix variance, hiyo iko sawa. Direct material yield variance 57 to 40. Favorable. If that is done, we are going to get what we call, we are going to get these two. When you add that, you are going to get 53 to 40 favorable. Now go ahead and give us what we call direct material cost variance. Direct material cost variance ni ngapi? Add it across. Uko na favorable, uko na favorable. Tunapata 54. The 54 to 40. Great. So is that okay now? Is that okay now? Is that okay? Is that okay now? Is that okay? Topic number 10 is compulsory. So you have to do August for me to make you understand this thing as early as today. You have to do August 2022. You have to do August 2022 question number 5B. You have to do August 2022 question number 5B. Tukikuja hapa on Tuesday, when we are going to do our revision, when we are going to continue with our revision, this will be part of the question to be discussed. This will be part of the question to be discussed. Anything that's challenging you, someone, this does not apply to direct labor, it is only for material. It is the material that we are mixing here. We are trying to look at the proportion of the raw material that's supposed to be used to come up with the final product. Direct labor ukiletewa kwa hii question, inabaki the same, nothing changes. Direct material for the different materials, that's what we bring in here. Anything about the causes of these variances, iko kwa ile 72 pages document. Iko na question na answer, hakuna note, it is a question and answer thing. So go through that document. Go through that document. So that is what we have. If you have a problem with this topic, you have to. You don't have a choice. Unaweza sema topic number 6, wacha niangalia kidogo kidogo ama pole pole. But this topic, you don't have a choice. You are going to find it there. And it is good I've just informed you. Topic number 4. Ukikosa topic number 4, toka kwa your exam. You are doing the wrong paper. If topic number 4 will not be there in your exams, my friend, you are doing a wrong paper. Just walk away, because it cannot be a management accounting paper without topic number 4. Bila topic number 4, just walk out of that exam. And this time round, you are going to be, you'll be given the stock or inventory management, where you have LIFO, FIFO, weighted average method. Then you must expect that if you're going to set anything about economic order quantity, iko kwa cut 2. You are given 1 to 300, 301 to 700. Alafu naambiwa advise these people, advise management. Please work on that. Please work on that. Aya, kuna hii, is it ABC or marginal? Marginal haikuletwa, sasa hiyo tunatarajia. ABC walileta, aya, ukikuja kwa topic number 3. Topic number 3 inakaribia kukaa kama consolidation in FR and AFR, because you cannot miss a question. Imagine, look at what you have in the cut. Very simple question. Umeambiwa, I was able to see very funny things there. I was able to see very funny things. Coming up with the cost function, y is equal to a plus bx. Ukipewa using accounts analysis, mtu anashindwa. Umepewa costs hapa. Direct material, hiyo tunajua ni 100% variable. Direct labor, variable. Is it? Aya, kuna percentage umepewa of the variable cost and the fixed proportion. Bring them together. Your interest here is basically to eliminate and have total fixed cost. The variable cost here, uliambiwa units. Just take this variable cost divided by the units. Y will be E fixed cost. You don't need to divide the fixed cost. Plus this variable cost per unit, then X. Watu wameshindwa kwa hiyo cut. Just imagine that simple question. Unapoteza tu hivyo. Which number was that question? Which number was this question? Ilikuwa number was it number on calculating value for sales? Are you always going to your store and say it, we produced 70,000, you multiply by selling price? There's that quantity which was demanded. When the market demands your product, what are you going to do? You are going to sell the products. So what is demanded is what you are selling. You can produce everything, but they demand nothing. So whatever they are demanding is what you are selling. Aya, sasa hapa watu walianguka tu wakiona. Limuru Limited. Angalia vizuri. Limuru Limited has established the following information for the cost of revenues for the month of October 2023. For the month of October 2023. Activity level umepewa 250 units. So just look for the variable cost peke yake. Unaona hiyo selling cost. So we have direct material. Direct material ni 81.25. Direct labor ni 16.260. Alafu production overheads ni 32.50. Hii selling cost, are they telling us something about it? Because even the production overhead, some percentage might be variable. So unaona hizo mbili, direct material, direct labor 16 to 40. Hapa hivi ni variable, fixed. Tumekuwa na zero. Aya, come down there to additional information number 1. All direct costs are variable costs. Na direct cost ni direct material na direct labor. Production overhead kuna ile percentage iko fixed. Tuangalie 20% of selling costs and 60% of production overheads are fixed. So give me, it means the variable of selling cost will be 80%. So what is 80% of the selling cost, which is 40.50? 80% ni ngapi? $80 ni ngapi? 80%. Watu wameshindwa. Si ni 32.40. That is the fixed. I mean the variable. About fixed. Fixed sasa ni 20% of that. 20% of that ni ngapi? 20% of that ni ngapi? 20% of that ni ngapi? Watu wanaangalia hizi vitu. 810. That's how we deal with the selling. Sasa mtu anakuwa na assume naoni hiyo kitu. Then we have production overheads. Production overhead tumeambiwa 60% of production overheads are fixed. So tafuta 60% of production overheads, which is 32.50. Ni ngapi? 60% of 32.50. 60% of 32.50 ni ngapi? 60% of 32.50 ni ngapi? 60% of 32.50. 60% of 32.50 ni ngapi? 60%. Question number 1 tunafanya. Question number 1 D. 60% of that ni 1950. Unaeka hapa, it is fixed, is it? 60% is fixed. 1950. Aya, the difference, that is 40% of 32.50. Ni ngapi? Hiyo ndio variable. 1300. Do we have any other cost that we are leaving out? We have selling cost tumetumia, production overheads tumetumia, total cost iko hapo, sales revenue, that's another story. Tunakuja hapa, get the total variable. Alafu upate total fixed pia. What is your total fixed? Is it 27.60? Total variable ni ngapi? Total variable ndio sasa tuelewane hapa. Total variable 28,915. Hapo umeambiwa total cost. Ushapewa hapo wamedivide walipeana to the total cost, which is 31, walipeana 31,675 is equal to fixed cost 27 2760 plus bx. Hii bx ndio hii total variable cost which is 28,915. Ukikuja hapo kwa bx, kuja hapa kwa bx. Bx is equal to variable cost per unit you multiply by the quantity. What was the budgeted activity level? Budgeted activity level ilikuwa ngapi? We are doing cut 2, question number 1D. Walisema ni 250. So bx tumesema x ni 250. Umebaki na b. So 250b is equal to 28,915. What is the value of b? Divide both sides by 250. 250. What is the value of b? What is the value of b? 115.66. Now come up back to your cost function. Y is equal to total fixed cost which will not change, 2760 plus variable cost x. Alafu anakuuliza atitengeneza income statement hapo chini Roman 2. Tengeneza income statement. Calculate the total profit at an activity level of 1,000, i.e. see this Y represents total cost. Na umejua total revenue pia umepewa hapo revenue as sales revenue. Imagine you are given that they are producing as per their budget, they are producing 250 and selling 250. So 250 times x is equal to 82,050. This x here is the selling price per unit. Selling price per unit. Ni ngapi? Ukidivide hapo unapata ngapi selling price per unit? Selling price per unit unapata ngapi? Unapata 328. So unakuwa na 328 is the selling price minus variable cost which is 115.66. You multiply by the quantity that they are selling, which is 1,000. Then you less fixed cost which will not change. Ukifanya hivyo utapata net profit. So that's how they're going to just confuse in the process. But basically they are testing topic number 3. So when we meet on Tuesday, I will look at topic 4, very important. Around 60% of your exams itatoka hapo. So topic 4, tuangalia vizuri. We look at something in topic number 7, which we said is compulsory. We look at something in topic number 3, we are expecting it. We look at something in topic number 9, we expect it, and maybe something there in topic number 10. So that is on Tuesday and Friday. I think if we just have those 4 hours, we'll be good to go. The remaining things, sasa ni video na kuendelea kusoma. Thanks for your time. Have a blessed night and let's meet on Tuesday. Same time, same